Trend following brings true diversification to your portfolio. It's a very disciplined, rules-based trading strategy. So it completely removes emotion or subjective decision-making.
It's probably the oldest known methodology for trading that has been documented.
It's not correlated with any of the traditional asset classes that you're probably familiar with and already invested with. So equities, bonds, real estate, and it's particularly uncorrelated during crisis periods for those other asset classes.
Trend following is performed by creating, testing, and applying mathematical formulas for detecting trends.
You know what a trend is? It's a fad. It's people doing the same thing. The same happens in finance. There are people who invest first and are influential, and other people tend to follow. But if you pay attention, you'll notice that this happens over a sustained time.
So trends occur because the underlying information that causes the trends diffuses into the markets, and then, like herding behavior in animals, they eventually have to accept ultimately that the trend is occurring, and that perpetuates the trend.
Our trend following strategy doesn't try to predict when trends occur. Our strategy is looking at price movements to identify when trends occur and to calculate when they're getting stronger.
The output of those formulas is what ultimately determines our position in each of the 50 plus markets that we trade.
And then we look at volatility and correlations of markets and become much more sophisticated in how we manage risk.
So as a result, we'll get into trades very incrementally. And as the trend is getting stronger, we'll add positions. As trends are starting to peter out or decline or deteriorate, we'll exit.
Staying in a trend requires riding out dips as well as the peaks. So you have to kind of ride that channel as it dips, which involves taking losses on the way to making profits.
And that's the main reason we have a completely automated, algorithm-driven system. No human emotions are involved.
One of the big advantages of trend following and managed futures is really the performance that we deliver at times when other asset classes are not doing so well. There's been many such examples. The IT bubble, Black Monday in 1987.
Then you had the financial crisis of 2008, and the only thing that made money during that period was trend following. We're not just long, we can be short. We're not just allocated to equities, we allocate to interest rates, we allocate to bonds, we allocate to currencies around the globe.
Trends have been going on for centuries, as far back as we have price information. And every 5 years or so, someone comes out and says that trends aren't going to occur anymore. And then that's when we start seeing trends again.
What I really like about trend following is that it's been around for decades, before the internet was even invented. And so every time there's a change, we're told that perhaps trend following is dead, it doesn't know how to adapt. But the reality is that trend following and managed futures has been the most dependable investment strategy that we've had for decades. And that's really the unique part of what we do, and that's why it really should be a core allocation in anyone's portfolio. It's the ability to perform well when everything is doing poorly.